Hello, my name is Revi Damayanti from Accounting Class 3, with NPM 234120007. Here I will explain material about bank health. Here is the material. 1. Definition: Bank health. Bank health is the financial and operational condition of a bank that reflects its ability to operate efficiently, comply with regulations, and maintain customer trust. Bank health indicators include capital adequacy ratio, liquidity, asset quality, profitability, and risk management. Healthy banks support financial system stability. 2. Financial ratios that assess bank health. Capital adequacy ratio, CAR. Non-performing loans, NPL. Loan-to-deposit ratio, LDR. Return on assets, ROA. Return on equity, ROE. 3. Internal factors that influence bank health. 1. Asset quality. Refers to how well a bank manages its assets, especially in terms of lending. Low-quality assets, such as non-performing loans, high NPLs, can endanger the bank's health and increase the risk of losses. 2. Risk management. The bank's ability to identify, measure and manage various risks: credit, operational, market, liquidity. Good risk management helps banks remain stable even when facing uncertainty or economic fluctuations. 3. Liquidity. Shows the bank's ability to meet short-term obligations, such as withdrawing customer funds. Banks with good liquidity can effectively address cash needs, which is important for maintaining customer trust and smooth operations. 4. External factors that influence bank health. 1. Macroeconomic conditions. Economic growth, inflation, and interest rates greatly influence bank performance. For example, during a recession, the level of non-performing loans, NPL, tends to increase, while high inflation can reduce customers' purchasing power. 2. Monetary and fiscal policy. Policies made by central banks, such as benchmark interest rates and mandatory reserves, as well as government fiscal policies, taxes, spending, can affect bank liquidity and profitability, as well as the bank's ability to provide loans. 3. Competition in the banking industry. The level of competition with other banks or non-bank financial institutions influences the determination of credit interest rates, service costs, and product innovation. Intense competition can suppress profit margins and affect bank health. 5. Supervision and regulation of bank health. 1. Role of the Financial Services Authority, OJK. OJK is responsible for supervising banking activities in Indonesia, ensuring banks comply with applicable regulations. OJK also assesses the health of banks through the CAMLs, capital, asset, management, earning, liquidity, sensitivity, assessment. 2. Supervision of Bank Indonesia, BI. Bank Indonesia has a role in setting monetary policy, monitoring liquidity, and maintaining financial system stability. BI can also intervene with interest rate policies or minimum mandatory reserves to control banking health. 3. Basel III, Global Regulatory Framework. Basel III is an international standard that sets minimum requirements for capital, liquidity, and risk management for banks. The aim is to strengthen the bank's resilience to economic shocks and financial crises. 4. Sanctions and firm action. Banks that fail to comply with regulatory standards may be subject to administrative sanctions, operational restrictions, or intervention by regulators, including liquidation if necessary.